Good morning, students. Welcome back. So today we'll start with this new set of topics, which is basically about the, you can say, financial sector in terms of the audit requirements. So banks and NBFCs. So these are the two that we'll talk about, right? Now, talking about banks first. Now, when it comes to banks, see, there is a specified structure, you can say, within which they operate. If you look at the requirements related to banks, when I say the requirements means the regulatory requirements, these are quite stringent and these are quite comprehensive. So you can say banks are significantly regulated. Okay, so that is what the audit consideration also involves. Why? Because if these are highly regulated, then some sort of considerations around those regulations will also be required to be looked at by the auditor. Okay. Now, because it's a bank, so that's why it is carrying on a business, or you can say, like any other entity, it's doing its business. So that's why some of those requirements of audit, which we can say will apply to any other entity, will also apply to a bank. Okay. So now we can say basically there are three requirements which will apply to a bank in terms of its audit. So one is about the audit. I understand you already understand quite a lot in terms of what the audit is, what the audit requires, what all procedures will have. Yes or no? Now, this being an entity which is carrying on some business, therefore, can we say that the basic aspects related to the audit will change in case of a bank? The answer is no. See, the audit is audit, whether it's a bank or it's any other entity, audit requirements will remain similar. Okay. So we can say all those audit requirements, which we understand will which apply to any other entity, will also apply to a bank. On the top of it, there are few more considerations which the auditor needs to have. And what is that? First, of course, will be about the various legal requirements which are applicable to a bank, because that becomes important for anyone to look at. Yeah, that is extremely important. Second, when it comes to the financial reporting on the part of the bank, or when it comes to the audit reporting which is there on the part of the auditor, because it's highly regulated and because there are some peculiar requirements which are specific to a bank, so that's why some of those reporting requirements may not be similar to what we discuss in case of any other entity. For example, if we talk about the form content of the financial statements, now there again we'll have assets, liabilities, and you'll have performance of the bank. Primarily those broad requirements remain similar, but when it comes to a bank, now there is a specified set of accounting standards which apply to them. And in case of a bank, the format of the financial statements which the bank prepares is also something which is specified by those regulatory requirements. Okay, which is not really as per that schedule, and which provides various divisions. Okay, under the Companies Act. When it comes to the auditor, in terms of its reporting requirements, there again, what do you find? That because it's about the audit of a bank, so that's why some more reporting requirements you'll see will arise on the part of the auditor. So of course, auditor will be required to issue an opinion. Okay, so that will remain. Opinion as regards what? whether the financial statements provide a true and fair view. So that of course has to be there. But on the top of it, there are various other reporting requirements which the auditor will also be required to do. Okay, yeah. So these we can say are some of the peculiarities. Now, let's try to understand the nature of the business of a bank. See, the banks, unlike any other entity, have got some peculiar, you can say, business environment. One, as we discussed, they are highly regulated. Two, see, the nature of business is such that public stake is involved. Okay, so it's all about public interest. And that is where you see this regulation also becoming quite stringent. Third, see, the nature of the bank is such that its transactions, its operations, they are quite significant. In fact, bank is a voluminous business. Yes or no? So the volume which you find in case of a bank, that's not something which you'll see in case of a small company or a medium-sized company. They are generally large. So even if you pick up a small bank, that is again quite large in itself. And that's where the systems and the processes which the bank needs to put in place, okay, that plays a very, very important role as far as its financial reporting is concerned. Yeah. So for a bank, systems and processes become extremely important. Now, what do you mean by that? See, when it comes to the systems and processes in case of a bank, gone are the days when you will see some sort of manual environment, or you can say manual systems or the manual controls in case of a bank. So that doesn't mean that the manual controls don't exist. They do exist. But the bank is now operating in such a manner that it's largely driven by the IT systems. Yes or no? Yeah. See, the technology has reached a stage and this has impacted the banks significantly. Impacted in a way that its operations are now largely systems driven, which are more of working in an automated environment, or you can say technological environment. Yeah. And that's where, when it comes to the audit of a bank, a detailed understanding of those systems becomes important on the part of the auditor. Why? Because till the time you don't have that clarity as around those systems, as around those processes in case of a bank, that really don't help you as an auditor. Yes or no? Yeah. So that's why we can say that these are the some specific requirements which you see becoming applicable in case of a bank, which you may not see in case of any other entity. Yeah. Okay. So now what we will do is we'll just try to pick up some of these specific requirements which you will see in case of a bank. So first, of course, that is the legal framework. As we have discussed, banks are highly regulated, so they are subject to various legal requirements. Banking Regulation Act, RBI Act. Okay. Then of course the State Bank of India Act. Banking Companies Acquisition and Transfer of Undertakings Act. In case of regional rural banks, you will have Regional Rural Banks Act. Information Technology Act. So those legal requirements which will apply to a company or any other entity will generally be there in case of a bank as well. But these legal requirements, which you can see on the screen right now, are in addition to what you will otherwise find. Okay, yeah. So now, when it comes to a bank, you can say has a regulator. Any bank in India has a regulator. Now, what is the meaning of the regulator? Regulator is the one who will be involved in regulating the activities, regulating the operations, or you can say who is there to overview, who is there to supervise in terms of how the banks are operating. And who happens to be the regulator? It is the RBI. Yeah. So RBI in India happens to be the regulator, which will be involved in monitoring as regards various functions and processes of the bank. In fact, each and every aspect related to the bank is something which becomes subject to that. Now, talking about the financial reporting, specifically on the financial statements. See, because the banks are subject to some specific regulations. Okay, so that's why if we go by this Banking Regulation Act, so this specifies the format of the financial statements. So for example, when it comes to a company other than bank, okay, say it's on Ind AS. So where do you get the format from? So you'll see the format in Schedule 3, Division 2. In case the company is the one on which Indian GAAP applies, you'll have Schedule 3, Division 1. Yes or no? So can we say that the same format will also apply to the bank? The answer is no. In case of a bank, this format comes from this Banking Regulation Act, okay, which actually prescribes the forms. So you can say the format will include the balance sheet, profit and loss, cash flow. All of those components of the financial statements will remain the same. But for every component, you can say a format is given, and that is called as form. Okay, for example, Form A, if you look at, that provides the format of the balance sheet. Form B, if you look at, that provides the format of the P&L. So we'll just try to also look at some of these formats by looking at the actual annual report, or you can say the financial statements of some of the banks today. Okay. And of course, other than these components in terms of balance sheet, P&L, you'll have similar sort of disclosure requirements. Right? Now, as regards these formats, as regards these criterias, all of these things you can say are largely driven by this regulation. Now, when it comes to the audit of accounts and the appointment of the auditor, now therein, what is the criteria? Generally, if you look at the banks, what do? They appoint 4 or more auditors. Particularly if you look at the PSUs, nationalized banks. Okay, in fact, private banks also tend to do this, but in case of nationalized and PSUs, it's a very common thing that you get to see. So what do? They will not appoint a single firm as their auditor. They will appoint 4 or more. Now there again, there are few reasons around this. See, if you look at the banks, it's not a small entity that we are talking about. So we are talking about some of the largest entities that are operating, which have got significant operations. Business is quite voluminous. So that's why Of course, by having more auditors, what do they have? They have this advantage that at least the workload is divided amongst the firms. Okay, so if the workload gets divided, so that anyways helps the banks in terms of the operations they do, in terms of the activities they carry out, and of course in terms of the timelines which they are required to meet as far as their financial reporting is concerned. Okay, and then of course the other benefit is around the opinions or the views, or you can say uh, advantages in terms of not only having one auditor in place, but by having maybe 4 or more auditors in place. So that actually helps in terms of achieving the desired quality. Further, because the banks operate in a manner that they are all spread out. Yeah. So they will have multiple locations in the form of what? Multiple branches. So that's how the banks operate. Now, for the audit of those branches, there again, the bank will have different branch auditors. So it's not the same set of, you can say, auditors who are doing the audit of this bank as a whole, which is also called as central statutory auditor. Instead, what do they do? For those branches, they will have different auditors. So maybe one auditor is auditing one branch, or maybe one auditor might be auditing 2 to 3 branches. Okay, so that again is something which they decide depending on the firm credentials. But this is again a very important aspect, because that's how the work is managed, right? And that's how the workload is divided, because for the banks, the timelines again happen to be quite stringent. Yeah, so for a firm or for a single firm to go and audit all of these locations within such a short span of time and then get ready with the deliverable with the desired level of quality may not be so easy, right? Now, when it comes to the banks, now auditor is appointed at the AGM. Okay, if you look at the banking company, whereas if you look at a nationalized bank, so that is appointed by the concerned bank acting through its board of directors. Right. In any case, approval of RBI is required before the appointment is made. Right. Now, talking about audit of a bank. Okay. So now what I'll do is I'll just quickly flip through the financial statements of a bank. I believe that is something which is going to help you in terms of getting a feeler as to how their financial statements will look like. And then we'll come back to this point again. Okay. So now let me just go back. So what I'll do is I'll just pull out the annual report of a bank. All right, so let's look at this. I'll just share the document. Okay, so over here, what we are looking at is audit report and the financial statements of a bank. So this is for 23-24. Now, I'll just move on to the financial statements first, because this audit report is all about any other audit report. Correct? No different from what you will otherwise see. Now, then there again, in terms of the audit report, we have IFC, which is again similar to what you will see in case of any other entity. Now, looking at the balance sheet. Okay, now In case of a balance sheet, what do you have? If you just look at the format, this format you will not find similar to what you will see in case of Schedule 3 format. Yes or no? Yeah. So you'll have capital and liabilities, capital to begin with, then of course reserves, moving on to the liabilities, deposits, borrowings. Talking about the asset side. Now on the asset side, there is a specific feature in terms of this format. What is that? See, these assets are given in the order of liquidity. Now, this is not something that you'll do in case of any entity other than bank. Okay, therein you do not have that criteria, but over here you have this criteria. Okay, so the assets are reported, if you can see, in the order of their liquidity. So first of all, you'll have the most liquid one. Then as you move further, okay, less liquid one. Now this is again a feature which you'll see in case of a bank. And then of course, some of the other items are specified on the face of the balance sheet. Now, if you look at the balance sheet, and if you look at the total of the balance sheet, one item which stands out, which you can prima facie see, happens to be what? Advances. Yes or no? Yeah. So this item happens to be the most important item on the face of the balance sheet, or you can say in the balance sheet of any bank. See, what is the nature of the business of a bank? They will collect money from public or from various sources in the form of what? Deposits. Of course, they will have borrowings, but as regards these deposits, you can say this is primarily the nature of business. And this money which the banks receive, what do? They will give this money as a loan to third parties. Now, all of these third parties could be different. They may be individuals, corporates, institutions, correct? So that's why when it comes to the balance sheet of a bank, the most important item happens to be what? Loans, advances. Yes or no? In fact, if you look at the total of the balance sheet, you will get to see this. So this particular item in itself comprises of a significant chunk. Yes or no? It's a significant chunk which you see in the balance sheet of a bank. And the other one, of course, will be the deposits, which you will see on the liability side. There again, if you'll see on the liabilities, this happens to be the one which has got significant proportion as around the total liabilities which are there. Correct? Now, in line with what you see in the balance sheet, now what will you have in the P&L? Here again, two items I would say will become important as far as the banks are concerned. The loans advances which the banks give to the third parties. Okay. On those loans advances which are given to the third parties, on those loans advances, what do they have? They will earn interest. Yes or no? Yeah. On those loans advances, banks will be earning interest. So that's why, once again, if you look at the P&L, the most significant item which you'll see on the P&L happens to be what? Interest income. Yes or no? Yeah, because that's the nature of business and that's how the banks earn. Correct. And if you look at the expense side, the most significant expenditure happens to be the interest which the banks will pay. Correct. Now, this interest the banks will pay on the deposits. Correct. Of course, it will also have some element of the interest on the amount which the banks borrow, but we are largely talking about the nature of the business here. So no, yeah. And then of course, if you go down this P&L, if you look at, because of different regulatory requirements, banks are required to create different types of reserves. So every year, what do you find? Out of the profits that they generate, they are required to create some specified reserves. Yes or no? Yeah. So why do they do this? That is again because of significant regulations which are attached to a bank. Correct? Yeah. Now, if you go further, then you will also see a cash flow statement in case of a bank. Now, cash flow has the same format. So cash flow, you will not say will be a different format. Cash flow will have the same format. Of course, the way the components will be put across in this case will become different. Okay. Then, if you go down, you'll have various notes to accounts, which are called as schedules in case of a bank. Schedule 1, Schedule 2, and so on. Right. But if you look at the balance sheet and P&L, so these are the forms. Okay, again, the form numbers are given around these. Right. Further, if you look at the schedules which are given in case of a bank. Okay. So now here again, all of these are the formats which are prescribed. Or you can say these are sort of forms which are required to be filled. So each and every format, or you can say each and every scheduled is numbered, and that's how that format is available. Okay. So if let's suppose the bank will not have any amount in a particular area, or if let's suppose that happens to be a blank one, which generally may not be there, but if let's suppose that happens, you don't change these numbers. Okay, these numbers will not be changed. So these numbers will continue to remain same. Right? Yeah. So that's what you will not change as far as the financial statements are concerned. And same goes with the P&L also. Here again, why? Because these are pre-numbered and these are more of available in the form of forms. Yeah, so these are called as forms. Okay. Now this was more of about the administrative part. Now let's talk about the audit. Now if we were to audit a bank, okay, and we are talking about the statutory audit. So what is it that we need to focus on? So now it's a risk-based approach which the auditor needs to pick up. So those areas which have got significant risk will be focused upon, and those areas which have not so significant risk, there again the auditor will not have so much focus. Correct? Now, to get into this requirement, what is it that you get to see? Advances. Now, advances, because it comprises of a significant chunk. So that's why what is going to be the focus area for the auditor? It has to be advances. Yes or no? It has to be advances for sure. And of course, deposits. That has to be the focus area. So does it mean that the remaining areas will not be audited? So we are not saying that remaining areas will not be audited. But you can say these are the ones which are generating from the core activities of the bank. And anyways, this happens to be a significant chunk. If you look at the proportion, this proportion I think would easily be 60 to 70% if you look at the current numbers. Right? So that's why a significant attention, a significant effort on the part of the auditor will be involved in which of these areas we just discussed. Correct? And of course, their corresponding impact when it comes to the P&L. When it comes to the advances, so the interlinked item will be the interest income which is earned by the banks. And when it comes to the expenses, so it will be the interest which the banks will pay. Right? No. Let's go back. All right. So what I'll do is I'll just take you back to the process. Now, there's one part we discussed to begin with, that when it comes to a bank, what do? In a way, you can say it's a three-step approach. Right? Now, what do you mean by three-step approach? Let us just take an example for that. Now, in case of a bank, an auditor will be, of course, looking at the audit approach, which will apply in case of any other entity. Okay. So we can say, what is that approach? That will be to get on to the understanding, okay, to do the risk assessment, evaluate the controls, and of course get on to the testing procedures, whether that is about control testing, substantive testing, any of those procedures, and to conclude that basis that. Correct. Second one will be which are focusing on those areas which are peculiar to the bank. And what is that? Legal requirements. These are peculiar to the bank, legal requirements. Yes or no? Yeah, so these are peculiar to the bank. And then, of course, third area, that is about the financial statements. When it comes to the financial statements, we can say the accounting principles. Why? Because these happen to be different in case of the banks. Not entirely, but the differences remain. Okay, and the first part we can say will be the application of various auditing standards. Okay, which anyways you are required to do, be it any entity that you will have. Correct? Yeah. So this is what you generally get to see. Now, as regards this general approach or the general procedures, now the question arises, because it's a bank, so should the approach of audit or should the way an audit is required to be performed, should that change? Answer is no. That will remain same. So that's why if you talk about the audit approach, so let's suppose if we talk about the audit approach. Now in that audit approach, what do you, so you can say it's a sort of a repetition. So why I'm just focusing on this point quite a lot, because it's something that you already understand about audit, because you have already understood, you have already covered audit significantly in terms of different requirements that you'll have. Now, what is the first step that you will have in case of audit? Of course, other than the engagement formalities, or assuming that all of those engagement formalities are in place, wherein the appointment is done, okay, eligibility and all is evaluated, independence has been looked at, yeah, all sort of requirements have been looked at. So what do you do? What is your first step? That is about understanding the entity and its environment. Yes or no? Understand the entity and the environment which it is subject to. Correct? This we can say is first step. Now, how will it differ in case of a bank? The only way it will differ in case of a bank will be in the form of obtaining an understanding related to legal requirements or some of those requirements which are different. Yeah. Now, what do you mean by understanding the entity and the environment? So you'll want to understand the nature of its business, the operations, the structure which the bank is having, the systems and the processes which are in place. Yes or no? All sort of things as an auditor you would want to understand. Only then you will be able to think about, or you can say you will be able to get onto the risk assessment. Otherwise not. Correct? So we can say the other part involves risk assessment. Now, are we saying that this is something which will not apply to any other entity? Answer is no. So this is something which you'll see will apply to any other entity. Yes or no? Yeah. So when we talk about the risk assessment, when we talk about the understanding or obtaining an understanding, that's something you'll see in case of audit of any entity. So the same applies to the bank as well. So now in case of a risk assessment, what do? You'll look at the risk assessment which the management has done, first of all, to begin with. Yeah, because eventually when it comes to the banking company or any other company, who will have the responsibility? So it's the management. Management has got the responsibility in terms of the financial reporting. Yeah. So what is it that the management has looked at? What all SAPs do they have? Right? And in terms of the risk assessment which the management has done, whether that is proper or not, that's something which the auditor will need to evaluate, and auditor will also do his own risk assessment, which will be about looking at the significant and not so significant risk areas. Correct? So this is what the auditor will do, to look at the significant risk areas, not significant risk areas. Yeah. Now, around the risk assessment, what are the controls which the management has got? Okay, the control systems which they have in relation to various processes. Now, what could be the processes? You can say, if we pick up this advances, then this in itself is a process which will have sub processes. In case of a bank, what are the types of risks that you will have? You can say credit risk is one of the largest risks which the bank will have. Operational risk, market risk, liquidity risk, foreign exchange management risk. Yeah. So there are a lot of risks which the bank is subject to. And all of these operations of the bank could be impacted due to that. So what all control systems are in place? Whether they are more of IT driven, which you will expect for a bank these days, in most of the cases, except for some manual controls, you will find most of them to be more of driven by the technology, right? So that is another aspect which is required to be looked at. And once you evaluate that, that is when, what do? That's when you will get on to the testing, or you can say you will get on to the execution. Okay, so that's the stage which you move towards, which is more about the field work. Okay, wherein you go to the field, you start performing various procedures which you would have thought through, considering the risk areas that you will have, which will involve which all procedures? Control testing to begin with. See, controls or control testing, when it comes to the audit of a bank, this plays a very significant role. Why? Because when it comes to the substantive testing, see, substantive testing has its own challenges. So we are not saying that you'll not be doing the substantive testing, or the substantive testing is not something which is relevant in case of a bank. Of course, it's relevant. Of course, it's something which the auditor is going to focus upon. But when it comes to the controls, because the banks operate in an environment, okay, wherein more of these sophisticated information systems are required. So that's why till the time these controls or these control systems are not understood and not tested, or you can say till the time the auditor is not able to achieve the comfort as around those systems, it will be very difficult to wrap up the audit. Or you can say it will be very difficult for the auditor to in fact plan the audit. So that's why most of the audit procedures will be centered around what? Testing of the systems. Yeah, because the way the banks operate, you can just think about it. Okay, any activity of a bank that you look at, what is that? That is driven by the systems. So if you audit the systems, if you get the comfort that the systems are operating the way they are required to do, then of course your risk attached to various processes, your risk attached to various activities, which may be significant, which may be not so significant, will automatically be sort of resolved. And that is where the banks will also have some sort of different internal controls mechanism, different types of, you can say, supporting audits as far as the management is concerned. For example, internal audit that plays a very significant role when it comes to the audit of a bank. Similarly, banks are also subject to concurrent audit. Now that is, again, you can say, is more of an audit in relation to the processes or systems, or maybe the transactions which the banks will have, okay, which is a routine audit in itself. Okay, so we can say some of these audits like concurrent audit. Similarly, to look at the compliances. Similarly, if you look at the internal audit, okay, all of these are what you will find these are more of regular. And this is again one area which the statutory auditor also needs to look at. Yeah. Why? Because without this support system, statutory auditor may not be able to get the complete comfort. So all of these audits or all of these control mechanism which the banks will have, that will eventually help the statutory auditor in drawing the comfort that whatever he has looked at or whatever is there in the financial statements or in some of these reporting requirements, so that's in line with what is required to be done. Okay. Now, as regards this execution, of course, the procedures around substantive testing and all of those things will also be required to be done. And then, of course, you will have the final stage. Now, final stage will be in terms of the audit that is required to be done, which is more about the conclusions which the auditor will reach. And of course, basis those conclusion, reporting which the auditor will be required to sort of provide. Okay. Now, when it comes to some of these set of activities or some of these things that we have talked about, now I'm sure you'll be able to understand most of these points and also understand the fact that these are not something new concepts. Why? Because you may be thinking, all of these requirements, don't we really look at when it comes to any other entity? The answer is yes. The answer is yes. And that's what you need to understand even in case of a bank. Yeah. So most of those requirements are not going to change. Those are going to be similar. Correct? Yeah. All right. So I'll just flip through some of these requirements. I think as around some of these stages we have discussed quite a lot. And one particular point over which I am emphasizing quite a lot happens to be the IT environment. Okay, which plays a very important role and a significant role as far as the bank audits are concerned. Now, as we discussed that the banks will also have some control mechanism in place. They will also have a risk management framework or risk mitigation system in place. And one of that support system which will help the banks achieve that happens to be what? Internal audit. Right? Which is more of a risk-based internal audit, which requires the banks again to focus upon the risks which they are subject to. Right? So now, as around these internal audits or these control mechanisms, because it's a routine thing which will go on in case of a bank. Okay. So throughout the year, you will see that some sort of audit is going on. But that is something which the statutory auditor needs to sort of look at in terms of what is the scope they are covering. Okay. which all periods they have been able to sort of cover in terms of the reporting requirement, and what is the outcome. Means some of their observations, some of their recommendations as to what is that, how is that going to impact the financial reporting, and if at all there is impact or not, what is it that the management is doing about it. Yeah, because if the management is working along with those sort of auditors in terms of improving the systems, in terms of ensuring that the risk management process of the bank is getting more and more strengthened, then it will give some additional comfort to the statutory auditors as well. Okay, now let's try to look at some small examples of the internal controls or this control system which could be there. Okay, now if you look at some generic one, so what could be the control? Staff and the officers of a bank should be shifted from one position to another frequently and without prior notice. Now, this is again a very common feature of a bank that you get to see. So you go to any bank, okay, generally, what is the banking that we are subject to? Retail banking. Okay. And that is something with which you will be able to relate to quite a lot. So if you visit a branch, you would have observed that every year or maybe every 2 years, you don't see the same person in respect of the operations or in respect of the activities of a branch. So let's suppose you go to a branch today, maybe there is a cashier. Next year when you go, you will not find the same cashier. Maybe that cashier is involved in some other activity. Yes or no? Or maybe that cashier is shifted to some other branch. Now, why is that done? That is nothing but a control system which the banks will have. And of course, maker checker concept, we can say work of one person should always be checked by another person. That anyways you have in case of different entities as well. Now, when we talk about cash, so cash should be kept in the joint custody of two responsible officers. So thereby, what are you trying to do? You're trying to get the control. Okay. High value cash receipts and payments should be verified by a senior officer or the branch manager, and the excess cash balance should be remitted to the currency chest accounting to branch retention limit on a daily basis. Now, this is again something very commonly you find the banks doing this exercise. Okay. Then if you look at some of the more items, loans advances. As we discussed, this is the most important area in the financial statements. Now, what could be the controls around the loans which are given? All necessary documents should be executed by the parties before the advances are made. So it should happen that an advance or a loan is given, but the underlying documents have not been prepared and signed, because that's a risk. It's a legal risk. Correct? Next, all the accounts which exceed the sanctioned limit. So let's suppose there's a sanctioned limit in respect of different accounts or drawing power, or are against unapproved securities or are otherwise irregular, should be brought to the notice of the management or head office on a regular basis. Now, this is again a kind of control you will have in respect of the advances which are given by the banks to different parties. Yeah. Similarly, for other areas as well, what do you find? You will find a control system must be in place. Now, there are some statutory requirements as we discussed. Some of the reserves the banks are required to maintain. Okay, some of the KPIs they need to look at and they also need to report upon. Similarly, there are some cash reserve ratios, statutory liquidity ratios they are required to maintain. Now, all of these ratios the banks can maintain when they are monitoring it. Okay, so now this is again, you can say a sort of regulation or a monitoring mechanism which the regulator has in place. But other than the regulator, it's about the bank who is self-regulating it. So the banks will also be required to look at all of these things. Correct. So cash reserve ratio happens to be an important ratio which the banks are required to maintain. So what is this? It's a specified minimum fraction of the total deposits of the customers, which the commercial banks have to hold as reserves, either in cash or as deposits with the central bank. Right? Now, similarly, if you look at the statutory liquidity ratio, so it's the requirement that every scheduled commercial bank in India is required to maintain in the form of certain liquid assets. For example, gold, cash, government approved securities before providing credit to the customers. Okay. Now, again, when it comes to the audit, now what is it that the auditor will have to do? So the auditor will have to ensure that what is required by the bank, whether the bank has done that or not, as far as its financial reporting is concerned. Okay. So there again, these compliances in relation to maintaining such ratios is something important on the part of the entity. So that's why auditor will also be looking at it. So what can the auditor do? First of all, obtain an understanding of the relevant legal requirements. Yes or no? Yeah. As around CRR, as around SLR. Correct. Then examine on a test basis consolidations regarding all of these positions prepared by the bank with reference to the related returns received from the branches. Also should examine whether valuation of securities done by the bank is in accordance with the guidelines which are prescribed by RBI or not. Yeah. So similarly, you will have different set of procedures in respect of some of these requirements. Now, when it comes to the assets, now on the asset side, we have already talked about what is the most important asset in case of a bank? Advances. Okay. So the advances which are given, they happen to be the most important item. Correct. Now, what is it that you need to do in respect of advances? And similarly, what is it that you need to do in respect of different assets which the banks will have? So let's try to understand some of the procedures in relation to some of these assets. When it comes to cash, cash will mean the bank, okay, money at call and short notice. What is the auditor's objective? Of course, to ensure that the assertions in relation to all of these assets, okay, are taken care of. Now, first procedure will of course be to ensure that the banks have a control mechanism and that is operating in an effective manner. Why? Because if that is not the case, then the checking may not provide the, you can say, the adequate comfort level or something which the auditor will want to achieve. But what could be the audit procedures? other than that control mechanism. Physical verification of cash. See, for a cash, it's a very common thing. Yeah. And if you look at the banks, they are required to do this on a daily basis. So every day when they close, what do? They will do a stock take. Stock take in terms of cash as well. Right? So now, auditor can also conduct this, and this can be conducted on a surprise basis. Yeah. So that surprise element could also be kept. Verify the ledger balances in each account with reference to bank confirmations. So if let's suppose loans are given to third parties, so the bank balances are maintained with the other banks. So those confirmations, those reconciliations, whether those are in place or not, if those are in place, whether some sort of reconciliation is required, and if that the differences, why the difference are there in the reconciliation, what is it that the management has done to take care of those reconciliations, and have those reconciling items been appropriately accounted for in the books or not. Correct? Yeah. Now moving on to the next item. Talking about investments. Okay. Now investments again is not something which is specific to a bank. Banks, like any other entity, may also have some investments. So what are the procedures that you may want to form on the investments? Examine the documents. Ascertain whether the investments made by the bank are within its authority. Means there should not be anything which is restricted. Ensure any other covenant or conditions which restrict, qualify, or abridge the right of ownership and or disposal of investments have been complied with by the bank. Acquisition of investments, including the disposal thereof, if any. Yeah. May be verified, but with the supporting documents, what could that be? A contract note of the broker, bill of costs, receipts, or any other similar evidence. Correct? Now, moving on to the next area, which happens to be the most important one when it comes to a bank. Advances. Now, this is where significant effort is involved. Okay. So now, what could be an advance? Say, for example, term loan given. Say, for example, cash credit is given. Yeah. Some sort of guarantees are given. Now, what would the auditor want to achieve in this? And what are going to be the audit procedures as around some of these items under the advances? One, KYC of the customers. Customers, you can say, are the parties to whom the loans have been given. So whether that has been verified or not. And of course, do some sort of sample checking to ensure that has been done. Examine all large advances while other advances may be examined on a sample basis. Now in this case, what an auditor will do is auditor will generally set a threshold. Okay, so that's how the auditor will go about it. There will generally be a threshold. And within that umbrella of threshold, what will happen? Anything that falls within that threshold auditor will want to pick that on a sample basis. Anything that crosses that threshold, maybe too big a number for an auditor to sort of, ignore. So that's why he'll want to focus significantly on those ones. Now, when it comes to a bank, see the number of advances and the amount involved, you will generally find is very high. Yeah, so that's why to check each and every advance is not possible. And that's why what is it that we need to consider? Two things. One is the control system. Second is the risk management process, including some of these audits. For example, internal audit, concurrent, etc. To get the comfort over some of those advances which are not picked up as a sample. Yes or no? Yeah. Now, with these advances, some of the norms of the RBI in terms of the accounting requirements, in terms of the revenue recognition by the banks is attached. So, for example, if the advances are performing, okay, and if the advances are non-performing, so in terms of the classification which the banks will have, in terms of NPAs or which are categorized as NPAs, what is the mechanism which the bank is following as far as the income recognition is concerned of that. Okay, so some of these factors are required to be looked at by the bank. Recoverability, of course, is very important because that's where the significant risk lies. What if the money is given, but it's moving into a stage which is NPA? Okay, and what is it that the banks are doing about the recovery of the amount? Okay, so there again, bank will have a quite stringent process. Now, what is it that the banks have done in terms of some of the defaulting parties? What are the systems do they have in terms of taking care of any defaults? Okay, right? So these are some of the things which the auditor will also want to look at on a test check basis, right? Now, moving further. Similarly, if you look at, of course, there can be significant audit procedures in relation to a lot of areas. Fixed assets, I would say, is not something which is very specific. Yeah, of course, it's like any other entity, they will also have some fixed assets. Now, over here, the term used is fixed assets because over here, the terminology has not been changed. So you may be thinking that everywhere it's called as PPE. Why it's not called as PPE? Because over here, this sort of updation is not yet done. Okay, because we are not looking at Ind AS over here, or we are not looking at Schedule 3 over here. Yeah. So whatever is the format, whatever is the regulation, so that has not changed the terminology. Clear? Then other assets. Now, in terms of other assets, it may be interest accrued or advances or some sort of inventory which the banks may be having. Yeah. So all of these are important on the part of the auditor. Now, talking about the liability sides in a similar way. Now, what could be there on the liability side? Now, on the liability side, in a similar manner, you may have capital. Now, in terms of capital, once again, the banks are required to have some sort of legal criteria in terms of maintaining what is the core capital and what is non-core capital, okay, which is called as a tier 1 and tier 2. Yeah, that again is important because you can say these are the capitals, or you can say these are some of the criterias which the banks are necessarily required to maintain at every point of time. Yeah. Reserves. In case of banks, you will see a lot of reserves. That is again arising due to various legal requirements. So, which all reserves are in place and how those are being maintained in terms of the reserve creation requirements, whether the banks have been doing that in an appropriate manner year on year or not. Then, of course, comes the deposits. See, now deposit happens to be the most important area as far as the liabilities are concerned. So when it comes to the deposits, it could be the customer deposits in the form of these savings accounts or the current accounts or the term deposits, which are also very commonly called as fixed deposits, which the banks will receive from the customers. Okay. And of course, other types of deposits. Now, there again, the procedures are important. Why? Because this is again a significant chunk as far as the balance sheet is concerned. So that's why after advances, the other area which is focused upon, or you can say wherein the significant effort is involved, happens to be the deposits. Because if you look at some of those line items in the P&L, okay, which again we'll just try to touch upon. So what will you see in respect of those line items in the P&L? You will see that once you perform the procedures on advances, in a way you have performed the procedures on interest on advances as well. And same goes with the deposits also, correct? Now, talking about the auditor's report, now for the auditor's report, as we discussed, of course, the banks will also be required to provide an opinion. So what we will do is we'll just flip through the audit report in case of a bank. Caro is not something which applies to a bank. So that's why Caro is not there. But of course, you have this IFC applying in case of a bank. Then there is another very popular report, okay, which is a top up, or you can say which is in addition to the main audit report, which talks about the opinion and all. That is called as LFAR, which the banks need to have in place. Okay, of course, it's on the audit side. Now, what is this LFAR? LFAR, you can say, is more of a checklist. Okay, it works more in the form of a checklist. I'm not really saying it's a checklist, but it's more of like a checklist wherein some sort of requirements are placed and the auditor needs to comment upon that, provide the remarks, to comment as to how those have been taken care of by the auditor, right? In these LFARs, what will happen? These are provided by the branch auditors as well. And of course, then there could be other reporting requirements as well. Yeah, a report on compliance with SLR requirements, report on whether treasury operations of the bank have been conducted in accordance with instructions of the RBI, certificate on reconciliation of securities by the bank, certificate on compliance by the bank in key areas of prudential and other guidelines, report on whether income recognition, asset classification, provisioning have been made. Yeah. So you can see there are a lot of reports which will go out. Now, concurrent audit, as we discussed, you can say it's more of a regular audit. Now, what does it involve? It's an audit or verification of transaction or activities of a bank or a branch of a bank concurrently as the transaction or the activity takes place. But this is not pre-audit. It's like it's done and getting checked, done and getting checked. So you can say it's more of like a check. Yeah. So how does it help? Any sort of errors, any types of non-compliances can be immediately taken care of. So that's why it's an important activity. It's an important audit as far as the banks are concerned. And this can really help the auditors, statutory auditors, in terms of finding out if there are any gaps which have been observed. There again, because it's a kind of audit in terms of the concurrent audit, so the report will be provided, some sort of observations will be provided, which the statutory auditor can also look at. Now, as regards the requirement related to the audit committee, banks are required to constitute an audit committee of their board. Yeah, in line with what the RBI requires. And what are the functions? So they will have similar sort of functions. One, to provide direction and oversee the operations of total audit function of the bank. Right. Review the internal inspection, audit function with special emphasis on the system, its quality, effectiveness in terms of follow. See, that's what is the most important part, because if you do that, then in a way you are able to control the things, otherwise not. Correct? Now, moving further, if you look at some of the requirements, I think what we can do is we can just quickly flip through this audit report. Okay, so now what I'm doing is I'm just taking you to the actual audit. See, idea is just to give you a feeler that this audit report that we are discussing is no different from any other audit report that you will find. So what do you have to begin with? Opinion. Yeah, as you'll have for any other entity. Then the basis for opinion. CAM. Yeah, because banks will find to be listed. Right? CAMs. This section around CAM. Okay. Once you have these CAMs, then the reporting requirement in respect of other information which goes along with the financial statements. Okay, so that section, management's responsibility, auditor's responsibility, and of course, all those other legal and regulatory requirements. Yeah, sort of standardized setup that you have for any other entity, right? And similarly, you have this IFC. Yeah, wherein you provide your opinion as an auditor on the control systems, right? Okay. All right. So now what we can do is we can spend some time in terms of looking at some questions. Yeah. So these questions we can just, sort of practice. All right. So I'll just share some of these questions. So we'll also try to pick up RTP. Okay. So now let's look at this first one. CA Harshit is conducting statutory audit of branch of a public sector bank. Okay. On examining 20 large advances of the branch, he finds that in 5 examined cases, okay, so in these 5 out of the 20 he has examined, loan applications have been filled up incompletely with important details left out. Okay. In these cases, it is also noticed that cash credit limits to the borrowers were enhanced during the year, but there are no records pertaining to an assessment of enhanced working capital requirements in respective borrowers' files. Some documentation should have been there, but it was not found. Okay, so no records pertaining to assessment of enhanced working capital requirements. Branch is unable to show such assessments or the workings in the system either. Okay, so neither in the hard copy nor in the soft form, right? So any form the documentation is missing, right? So this is what the auditor has observed. Further, all the 5 accounts were found to be operating satisfactorily. All these 5. These accounts have been classified as standard assets, of course. Would the above information prompt the auditor to suggest change in asset classification of above accounts? What does the depicted situation reflect? Okay, so let's look at this. An account becomes NPA when it ceases to generate income for the bank. If you look at these 5 accounts, they are operating effectively, satisfactorily. There are no reasons for suggesting the changes in the classification. As regards these matters, okay, so these two sort of observations. One that is about incompletely filling up loan applications. Second, records which were missing for assessment of enhancement in the working capital shows that internal controls over the advances in the branch are not proper. Yes or no? Clearly, internal controls are not proper. Yes or no? The above said situation shows deficiencies in credit appraisal at the branch level. So what will the auditor be required to do? Highlight that in the LFAR, that is long form audit report. Right? Clear on this? Yeah. All right. So let's look at the next one. So now, in the course of audit of Good Samaritan Bank as at 31st March 24, following observations were found. In a particular account, there was no recovery in the past 18 months. Bank has not applied the NPA norms as well as income recognition norms to this particular account. Okay, money is not getting collected. So I think the criteria related to NPA, related to income recognition gets triggered. But that's not done. When asked, the bank management replied that this account was guaranteed by the central government and hence these norms were not applicable. Bank has not invoked the guarantee though. So you are required to respond as to what do you think about this? Right, wrong? What should have been done by the bank? Would your answer be different if the advance is guaranteed by state government? See, in this case, this account is guaranteed by central government. What if this is guaranteed by the state government? Okay, so will the answer change then? That's the thing we are required to look at. So let's look at this. If the government guaranteed advance becomes NPA, then for the purposes of income recognition, interest on such advance should not be taken to income unless it is realized. So what do? You will record that on a cash basis. However, for the purposes of asset classification, credit facility backed by central government guarantee, the overdue can be treated as NPA only when central government repudiates the guarantee. See, there were two problems. One related to the asset classification, second income. Since the bank has not invoked the guarantee, the question of repudiation does not arise. Hence, the bank is correct to the extent of not applying the NPA norms for provisioning purposes. But this exemption is not available in respect of income recognition norms. Hence, income to the extent not recovered should be reversed. Okay, that's what the bank should have done. Further, now if let's suppose instead of central government, okay, that's the point we were discussing. If let's suppose instead of central government, it was state government, then what do? See, the situation would be different, no doubt, if the advance is guaranteed by state government. Because this exemption is not applicable for state government guaranteed advances, where the advance is to be considered as NPA if it remains overdue for more than 90 days. Unlike if in case it's guaranteed by central government. In case the bank has not invoked the central government guarantee, though the amount is overdue for long. So we need to ask the bank, okay, the reasoning as to why they have not done that and report that in LFAR. Clear? Now, in the same bank, during the audit, there was another observation. What was that? Advance portfolio of the bank comprised of significant loans against life insurance policies. Right? In this case, in relation to audit of these advances or loans which have been given against LIC policies. So what is the meaning of this? A loan has been given and what is kept as a security? LIC policy of the customer. Okay, so that's the arrangement. Now in this case, how do you audit this? So you are required to design an audit program to verify this. I think quite simple. Yeah. So what will be the audit procedures? 1. Auditor should inspect policies, life insurance policies, and see whether they are assigned to the bank and whether such assignment has been registered with the issuer. So this is the requirement in case of bank. Number 2, auditor should examine whether premium has been paid on the policies and whether, see, there's no point keeping the policy as a security if the policies are lapsed. So what will the bank do about it? Yeah, so the bank needs to ensure that the premium on that is getting paid. So the policies remain active. They do not lapse. Correct? Third, certificate regarding surrender value obtained from the insurer should be examined. Fourth, auditor should particularly see if such surrender value is subject to payment of certain premium. Amount of such premium has been deducted from the surrender value. Okay? Clear? These are the audit procedures will do. Right? Okay, so let's look at one more. Next, ABC Bank had sanctioned credit limits of 100 lakhs to Messrs. Volcart Limited on 1st September 20. Okay, so this is the sanction limit. Renewal of limits was due on 1st September 23 after 2 years. While doing the statutory branch audit for the year ended 31st March 24, you find that renewal has not been done, even though 180 days are over. Bank says that renewal process has been initiated on time and most of the documents are received. Account is operated regularly and is in order. Balance is maintained without drawing power. It also shows a letter from Volcart stating that due to a sudden death of their auditor, a new auditor had to be appointed. Now, this seems to be an excuse or maybe the genuine reason which they have provided. Procedure for appointment took some time, and the new auditor was doing the audit all over again. The limit was not renewed till 31st March 24. However, audited financials are received on 10th of April and the renewal letter was issued immediately. Your assistant is insisting that the account must be classified as NPA since limit was not renewed on 31st March. What is your opinion? Okay, yeah. So in this case, what do you do in such a situation as an auditor? Right? So let's look at this. If we look at the guidelines which RBI prescribes, account should be classified as NPA if renewal is not done in 180 days. However, in the present case, operations in the account are excellent. Bank has shown a letter from the company that due to certain reasons, audited financial statements are delayed. So there are some genuine reasons for the delay. Further, limit has also been renewed before the signing of the audit report. Of course, it's after 31st March. So if you look at the chart, it's after 31st March. But let's suppose this is the date of approval of financial statements. So before the financial statements are approved, somewhere over here, limit has been renewed. Thus, even if the sanction was issued after the balance sheet date, it relates to the position as on the balance sheet date. Therefore, you will say it's an adjusting event. Okay. It's also a matter of substance over form. Yeah. So therefore, what should the auditor do? Auditor should consider this as a standard asset. Looking at some of these fact pattern. Yeah. On the basis of these facts, all of these situations which are available, that's what the auditor needs to consider and decide. All right. Clear? So I think we have got some more questions which we can just look at practice. But what we can do now is we can take a break. Okay. And then we'll continue. Right. So Manish, we can take a break now. Yeah. All right. So now we'll continue on the same sort of questions. Okay. So we'll pick up some more questions now. Okay. So let's look at this. You are auditing a small bank branch with a staff strength of the manager, cashier, and 3 other staff. Okay, so now what is that? S1, S2, S3. Amongst the allocation of work for other areas, S1, so you can say in a way these are the courts for the persons, is the PN. So now there's some additional responsibility which is assigned to this. Also opens all the mails, means emails, and forwards it to the concerned department. Right. It does not have a signature book so as to check the signatures on important communications. Right. Now, S2, next person. S2 has the possession of all the bank forms, be it checkbook, demand draft, pay order books, traveler's check, foreign currency cards. He maintains a record meticulously, which you have test check also. Means that has been verified. However, no one amongst the staff regularly checks that. So auditor has verified, but staff, in terms of their internal process, that checking system doesn't seem to be there. Right? Now, you are informed that this is a small branch. Okay. So the shortage is there, manpower is not there. Again, a very common problem you'll sort of associate with any small setup. Yes, seems to be there in case of this branch as well. And that's why it is not possible to always check. Okay, so this is what the branch persons are saying. Now, your comments are required. So, see, the question is that can we say that just because of the size, which is small, so that's why some of these, sort of systems, procedures, which need to be in place may not be operating at all. Forget about whether they are operating in an effective manner or not. They may not be operating at all. Why? Because the size is small, people are not there. So can that be the plea? So can that be the excuse? So that's the question. Understood? Yeah. Again, a very relevant one, and you may sort of, associate with this in terms of the small setups when you work with, or small setups that you go and audit at times. Now, in this case, let's understand. So the banks are required to implement and maintain a system of internal controls for mitigating risks, maintaining good governance, and also to meet the regulatory requirements. Now, we can see some internal controls that are violated in the above situation. What are those? S1, who is a PN, opens all the emails and forwards it to the concerned person. Further, doesn't have a signature book so as to check the signatures on important communications. Is not in accordance with implementation and maintenance of general internal control. All the emails should be opened by a responsible officer. Signatures on all the letters and advices received from other branches of the bank or its correspondence should be checked. See, one is who is opening, this should also be checked by an officer with a signature book. So this is one problem from the roles and responsibilities that been assigned to S1, you can say. So it's not that S1 is at fault. No, it's about the branch is at fault. Correct? Now, all the bank forms, be it checkbook, demand draft, pay order books, traveler's checks, foreign currency cards, they need to be kept in the possession of an officer. That's one, which seems to be there. And another responsible officer should verify the issuance as well as stock of such inventory. So this is a kind of inventory which the banks maintain. In the given situation, S2 has the possession of all forms. He maintains a record meticulously, which were also verified on a test check basis. Further, contention of the bank that being a small branch with shortage of manpower, they are not able to check the work and records on a regular basis is not tenable at all. Why? Because such lapses in the internal control pose a risk of fraud, which is a significant risk. Yes or no? Yes or no? Yeah. Therefore, what needs to be done by the auditor? Of course, report this. Correct? Next. NRF Bank Limited is suffering from huge number of NPAs. During the month of April 24, management of the bank decided to sell some of the NPAs. See, NPAs can always be sold. So it's like those receivables, you can go sell them in the market. Okay. So in the month of April, management has decided to sell. Bank is doing this exercise for the first time. Management, what they have done is they have selected following NPAs for sale. So some of the parties, their names are given, which they plan to sell. Okay. So we are given the name of the party, which is planned to sell, the date from which it's been marked as NPA, and the amount involved. So this is the information which is available to us. Correct? Now, being the internal auditor of the bank, you are required to scrutinize the proposal made by the branch. That's one. And help them by providing specific points to be considered. Okay. So let's look at this. In case of sale of NPAs by the bank, auditor should examine the following things. First, policy laid down by the board of directors in this regard relating to procedures, valuation, and delegation of powers, including non-performing financial assets that may be sold, norms or such sale, valuation procedure, and the accounting policy. Okay, so this is one. Two, only such NPA has been sold which has remained NPA in the books of the bank for at least 2 years. So that's the another thing. Third, assets have been sold without recourse only. That is, entire credit risk associated with the NPA should be transferred to the purchasing party. See, it shouldn't happen that asset has been sold, but the credit risk is still not passed on, right? Subsequent to the sale of the NPA, bank does not assume any legal, operational, or any other type of risk related to those NPAs which have been sold. See, one is, of course, credit risk should be passed on completely. Any other risk should also be passed on completely. Next, NPA has been sold at cash basis only. Yeah. Any contingent price should not be attached. Contingent means when you go sell something that, okay, I'll pay you 100 provided this condition is met. No. So it has to be sold on cash basis only. The entire sale consideration has to be received on upfront basis. So you don't defer it. Okay. Next, bank has not purchased an NPA which it had originally sold. So that's another important factor. On the sale of the NPA, same has been removed from the books of accounts of the selling bank on transfer. Again, a very common relevant point. Next, if the sale is at a price below the net book value, net book value means book value less provisions held, shortfall should be debited to P&L. Okay. If the sale is for a value higher than a net book value, so what do? Excess provision which was done in the books should not be reversed, but will be utilized to meet the shortfall or the loss on account of sale of other NPAs. Okay. In the given situation, management of this bank is considering to sell following NPAs during the month of April. Yeah, so this is the table which is provided to us in the question as well. Now, looking at the above mentioned conditions, what do? Auditor is required to ensure that only such NPAs are sold which has remained as NPA in the books for at least 2 years. So that's what you'll do. Considering the facts given in the question, all the NPAs except for dairy works are prior to April 21. That means 2 years prior to the period of reporting. In view of the above provisions, management of NRF Bank Limited can sell all the NPAs except NPA of 54.24 lakhs pertaining to dairy works. Why? This can't be sold because it has remained as NPA in the books of the bank for less than 2 years. Now you may be thinking, where do we pick up this period from? We are looking at the month of April for this. Yeah. So this is an important criteria one needs to look at. Clear? Clear on this? Yeah. So let's look at the next one. PDSJ and Associates are the statutory auditors of a scheduled commercial bank. And this reporting year is 23-24. While evaluating the internal control over advances, okay, it came to their notice that classification of the term loan borrower accounts into SMA as well as NPA is done in the system on the following lines. In case full dues are not received on a particular due date, borrower account is immediately considered as overdue on the very next day. For example, if the due date of loan account is 31st March 23 and the dues are not received on 31st March 23, it shall be considered as overdue on 1st April 23. Okay. If it continues to remain overdue, then the account is tagged as SMA1 on 1st May 23. If it continues to remain overdue further, then the account is tagged as SMA2. So you can say these are the categories. In this order, this has to move as per the regulatory requirements. If it continues to remain overdue even after being tagged as SMA2, it gets classified as NPA on 30th June 23. You are required to evaluate the above control designed by the bank in the system for the purposes of exercising control over such advances in compliance with regulatory guidelines. Okay. Now, design of the above control instituted by the bank in its system is not in accordance with the regulatory guidelines. Okay. Any amount due to the bank under any credit facility is overdue if it is not paid on the due date which is fixed by the bank. The borrower accounts are flagged as overdue by the banks as part of their day-end processes for the due date. Okay. Classification of the borrower accounts as SMA as well as NPA is done as part of day-end process. Now this is important. As part of day-end process for the relevant date. SMA or NPA classification date is the calendar date for which the day-end process is run. In other words, the date of SMA or NPA reflects the asset classification status of an account at the day end of that calendar date. In the given situation, due date of a loan account is what? 31st March 24. And full dues are not received by the bank before it runs the day end process for this date. So the date of overview shall be what? 31st March itself. You will not be looking at the next day. Yes or no? Because next day is next day. You can't say next day is the part of same day. If it continues to remain overdue, then this account shall get tagged as SMA1 upon running day end process on 30th April. Why? Well, that's the period when 30 days get completed of being continuously overdue. Accordingly, what should be the date of classification as SMA1? 30th April. Similarly, if the account continues to remain overdue as SMA1, it will get tagged as SMA2. Okay. But that will again happen on what? 30th May. Another 30 days you will pick up. Okay. And if it continues to remain overdue further, what do? Call it as NPA. Again, after picking up next 30 days, which falls due on what? June 29. Correct? Yeah. So this is the criteria we need to consider. Next. You have been appointed as the concurrent auditor of a branch of Silver Bank Limited, which primarily deals in foreign exchange transactions. During the audit, you noticed discrepancies in certain inward and outward remittances, as well as unusual fluctuations in nostro account balances. In this case, what audit procedures you would implement to verify the accuracy and compliance of foreign exchange transactions of this branch? Okay. So what all procedures you will pick up? What is it that you will do? Correct? Now, in this case, first, check the foreign bills negotiated under LCs. Check the FCNR and other non-resident accounts, whether debits and credits are permissible under rules. Check whether inward or outward remittances have been properly accounted for. Examine the extension and cancellation of forward contracts for purchase and sale of foreign currency. Ensure that they are duly authorized and necessary charges have been recovered. Ensure that balances in nostro accounts in different foreign currencies are within the limits as prescribed by the bank. Ensure that the overbought, oversold position maintained in different currencies is reasonable, considering the foreign exchange operations. Ensure adherence to the guidelines issued by RBI or HO of the bank about dealing room operations. Ensure verification or reconciliation of nostro and vostro account transactions or the balances. Clear? Clear on this? All right. So with this, I think we have looked at some examples. Okay. We'll look at some more questions. But what we can do is maybe we can just pick up this, I think, NBFC also. Right. So what I'll do is I'll just move on to the next section, okay, which is about NBFCs. Let's talk about NBFCs a bit, and then we'll pick up some more questions. Okay. All right. So now looking at NBFCs. Non-banking finance companies, NBFCs. You can say the nature of business of NBFCs is quite similar. I won't say entirely similar, but to a great extent similar in terms of the operations they will have, in terms of the systems and procedures they need to put in place. Those are again, I would say, somewhat similar to what the banks will have. Okay. But when it comes to NBFCs, definitely there are some differences. But one thing is very common, whether it is about banks or NBFCs. And what is that? Regulatory environment. See, because here again, the nature of business of NBFCs is, you can say, sort of similar. They are also involved in financial business. So that's why they are also heavily regulated. So let's try to understand what an NBFC is. If you look at the technical definition. So you can say a financial institution, which is a company, a non-banking institution, which is a company, and which has as its principal business the receiving of deposits under any scheme or arrangement or in any other manner, or lending in any manner, right? Such other non-banking institution or class of institutions as the bank may, with previous approval of central government and by official gazette, notify. Okay, now see, there is a criteria generally to find out whether an entity is carrying out the operations of NBFC or not. You can say it's also a kind of test, okay, called as 50-50 test. Now, what do you mean by that 50-50 test? So it says if a company has got financial assets which constitute more than 50% of total assets, and means there are two criteria, two conditions you always need to look at. For the same company, if you look at its income from financial assets, that income constitutes more than 50% of the gross income. So we'll say it's an NBFC. That's why this is also called as 50-50 test. So at one place you are checking the financial assets in relation to the total assets and income from those financial assets in relation to the gross income. Right? Now, here again, for the NBFCs, the regulator happens to be RBI. No NBFC is allowed to commence or carry on the business of NBFC without obtaining the certificate of registration issued by RBI, having net on funds. So there's again a threshold criteria for that, right? Clear? So these are the two mandates on the NBFCs. Now again, you may have different types of NBFCs, which you look at in respect of the NBFCs which are registered with RBI. Okay, in terms of deposits acceptance or otherwise. So you call it as a deposit and non-depositing sector, right? By the kind of activities they will have. Okay, so for example, investment and credit company, core investment company, right? You may have this infrastructure debt fund, NBFC, asset finance company. So all of these are what they are, all examples of NBFCs. Different criteria are picked up in terms of their classification requirements. Then there are certain companies which, though happens to be in the nature of NBFC business, they are exempted from registration from RBI because they are regulated by some other regulator. For example, housing finance institutions, they are regulated by National Housing Bank. Stock exchanges, they are regulated by SEBI. Merchant banking companies regulated by SEBI again. Okay. Similarly, if you look at Nidhi companies, they are regulated by MCA. Yeah. So the regulation has to be there, but the thing is that regulation as regards that RBI is not there. Yeah. So that's the thing. Okay. Then of course, on the basis of the layers that you will have, there are 4 layers for the purposes of classification of NBFC and the regulations. For example, capital requirements, governance standards, prudential regulations. So now all of these layers are based on their size, activity, and the perceived riskiness. So the risk involved. Yeah, so you may call it as base layer, middle layer, upper layer, top layer. Okay, so that's how you'll look at it. Now, let's also try to understand the difference broadly that you'll have between an NBFC and a bank. See, if we look at the NBFCs, they cannot accept demand deposits. However, some NBFCs can accept term deposits, but if you look at the banks, that's what they always accept. Demand, term, all. NBFCs do not form part of payment and settlement system, cannot issue checks drawn on itself, unlike what the banks do. DICGC, okay, so it's a facility, insurance facility, which is not available to depositors of NBFC. So you can say kind of insurance facility, which you have in case of banks. No minimum exposure to priority sector, which is required by NBFCs, unlike the banks. Okay, then of course, around the capital requirements we have discussed, and here again, in respect of the capital requirement, there are types of capital. So tier 1 is there. Tier 1 happens to be the core capital. Then tier 2 is there. So the criteria is defined as to how do you get onto that tier 1, tier 2. Okay. Then of course, the assets need to be put in place in terms of their assessment and the weights of risk you'll assign to them. Yeah. So for which again, some norms are defined. What do you do for that? Yeah. So all of these norms come from the RBI regulations only. Clear? So this chart you can look at. Income recognition, again, it's very much similar to a bank. Here again, the NBFCs are required to do what? Segregate their assets. Okay. So NBFCs, similar to the bank, will also have that balance sheet, but over here the format is defined. And that format comes from Schedule 3. Okay. Those one over which the Ind AS applies. So we have this Schedule 3, Division 3. In this case, if you look at the balance sheet, here again, what is going to be the most important area? Advances. Well, that's their core business, right? And of course, if you look at the P&L, you'll have the interest income on advances. So that is again their core business. Now, as regards the classification of those advances, we are talking about those advances, only loans advances. So here the RBI requires that segregation into standard, substandard, doubtful, loss assets. And again, depending on the categorization that you'll have, okay, provisioning norms are attached same way like it is there for the banks. But the percentages, the criterias are different. Okay, so the classifications are same, but percentages are not same. Classification criterias are always not same. Okay, yeah. So now all of these norms, I'm sure you would have looked at. Provisioning requirements happen to be extremely important as part of this chapter, I would say. Yeah. Now, what are the audit procedures? Now, when it comes to audit of NBFC, I would say we need to follow the same sort of audit approach that we have discussed in case of a bank. See, it's actually no different from what you have in case of a bank. The only difference being the differences that we discussed between bank and NBFC. Yeah. So we'll have those standard set of audit procedures in terms of understanding the entity, in terms of doing the risk assessment, in terms of looking at the control systems, in terms of designing the audit procedures accordingly, getting onto the execution, and then of course, reaching the conclusions so that the reporting can be done. Over here, the focus again will be on what? Various regulations which the NBFCs will be subject to, right? And of course, different reporting requirements which could be placed upon the auditors of those NBFCs, in addition to, of course, the main audit report which you will have, right? which is about the opinion on the truth and fairness in the financial statements. Now, RBI has prescribed different norms in terms of classification of frauds by NBFCs, which actually happens to be a very critical area, not only from the auditor's perspective, but also from the management's perspective, for them to look at, for them to find out as to know what is it that may go wrong, and if that is intentional or intentional, right? Which is all about, again, the risk management system which the entity will put in place. Right. So what are the duties? Again, the duties are in respect of some of these submissions and of course around the audit procedures to be performed. Now, CARO is one thing which is applicable to NBFCs, unlike what the banks. Okay, over here, some of the specific aspects related to CARO are required to be taken care of. Right, so that is an important reporting requirement when it comes to NBFCs. Now, Ind AS is something which applies to NBFCs. So when it comes to Ind AS, so there again you have this criteria on the basis of net worth, on the basis of listing. Yeah, but as we stand today, so it's like any entity having a net worth of more than 250 or listed. That's where the Ind AS will apply. Yeah. And that's how we need to look at it. Format we have talked about. Yeah, so we also have this illustrated format for you to look at. See, the good thing about this format again is because the nature of this entity is such that these assets which are reported, even in this particular format, they are in the order of liquidity. If you can see this. Yes or no? Similar to what the banks will do, in the order of liquidity. Right? Otherwise, as we discussed, largely the items will be similar. And of course, the major chunk will be towards the advances. And that's why if you look at the P&L, so in the P&L, what is going to be the most important item? Interest income on those advances. Correct. Yeah. Here again, some sort of reserves or criteria related to reserves and some ratios are required to be maintained, which one needs to look at. Okay. Then of course we can quickly look at some of the differences between the format which you find in case of Ind AS financial statement of NBFC vis-a-vis any company other than NBFC. So you'll get a perspective as to how the things are changing. Of course, you may want to compare it to a bank, but let's also compare this to a company other than a bank. NBFCs have been allowed to present the items of balance sheet in the order of their liquidity. Correct? Which is not allowed to companies required to follow division 2. Next. NBFC is required to separately disclose by way of note any item of other income, other expenditure which exceeds 1% of the total income. So if you look at division 2, it requires disclosure of any item of income or expenditure which exceeds 1% of revenue from operations or 10 lakhs, whichever is higher. NBFCs are required to separately disclose under receivables debts due from any LLP in which its director is a partner or member. NBFCs are also required to disclose items comprising revenue from operations and other comprehensive income on the face of statement of profit and loss, instead of showing those only as part of the notes. Okay. Separate disclosure of trade receivable which have significant increase in credit risk and credit impaired is required. Conditions or restrictions for distribution attached to statutory reserves have to be separately disclosed. Yeah, because this is again one feature, or you can say one peculiar requirement that you will have in case of NBFCs and not in case of other companies generally. Correct? Yeah. All right. So now what we will do is again, we'll pick up some questions to practice around NBFCs also. So just give me a minute. Let me just open the document. And what we will do is we'll also pick up some questions from the RTP as well, right? Just give me a minute. So what we can do is I'll just move on to the RTP first. So let's look at some questions now, right? Okay, so this is RTP January 2026. Let's look at this. Fair bank. Okay, so it's related to a bank. So we are now looking at this RTP, please. Fairbank has appointed CA as the statutory auditor for financial year 24-25. Now, during the audit, following are the observations. Pending cases with suppliers amounting to 2.5 crore. Disputes with ex-employees regarding retirement benefits with claims of 1.2 crore. Ongoing tax litigations with a potential liability of 3 crore. Considering the above, CA is concerned regarding the claims not acknowledged as debts. State the audit procedures that CA should perform to verify claims not acknowledged as debts. I think it's a straightforward one. Yeah. So what are the audit procedures that you'll have for this particular item in the financial statements? So let's look at this, right? So I'll just move on to the audit procedures. First, examine the relevant evidence. Correspondence with the lawyers, others, claimants, workers or officers, workmen union, officers union. So that's one. Review the minutes of meetings of board of directors or committees of board of directors, contracts, agreements, arrangements, list of pending legal cases, correspondence related to taxes, to identify the claims against the, again, a very important procedure and very commonly done. Minutes. This will give a good insight to the auditor. Third, ascertain from the management status of claims outstanding. So the discussions, inquiries, okay, some sort of deliberation may be involved. Review of subsequent events, again, a very important procedure, because this can throw up some of these sort of, you can say, liabilities or the ones, these litigations or these claims or these sort of demands, right? Okay, so now let's look at some more questions. All right, so now let's look at this. CAM is appointed as the statutory auditor of FinCorp Limited. And we have this financial year 23-24. This company is an NBFC and it is covered under NBFC systemically important non-deposit taking company. Now this is again a criteria for you to assess some of the regulations that will apply to that particular company. To comply with the RBI prudential norms for asset classification, FinCorp Limited has made following provisioning in respect of loans, advances, other credit facilities. So you are given the details in respect of some of these assets as at the year end. So I think the classification is given in terms of what is standard, what is substandard, what is doubtful, what is loss asset. So that's one. The balance is given. And the information about what is secured is also separately marked. And then of course the provision which has been considered. So this number is also already available to you. So this entire information is available. Now, CAM is of the opinion that company has not provided this appropriately. Okay, so this provisioning is not appropriate. So that's the view of the auditor. Now, you need to comment on this first. Means, do you agree whether this auditor is doing the correct assessment or not? In this context, explain the provisioning requirements. Now, you don't only need to comment on this, you will also be required to explain. So that means you'll have to get on to the regulatory requirements around it. Yeah, so you can say that's how you'll support your answer. Explain the provisioning requirements. Okay, now let's look at this. Now, what are the provisioning requirements and whether this provision is in line with those requirements or not? So the provisioning requirement in respect of loans, advances, and other credit facilities, including bills purchased and discounted, shall be as under. What is that? For the standard assets, and we are talking about the type of NBFC that we have, correct? Percentage is given. For substandard assets, it's given. Doubtful, it's given up to 1 to 3 years. Loss assets again. Okay, so this is the requirement, or you can say this is the legal requirement which you will specify to begin with. Now, in the given situation, this is an NBFC which is covered under NBFC. Sorry, this is an NBFC which is covered under NBFC systemically important non-deposit taking company and deposit taking company Reserve Bank Directions 2016 for the financial year 23-24. FinCorp has made the following provisioning in respect of the loans. So now given below is the provisioning details available. Okay, so we have put down this information from the question itself. Okay, so you can say this part is available in the question itself. So this part, okay, and of course this part. Now, what do we need to put down additionally? Now, if you go by the regulatory requirements, what is the percentage that should have been there? Okay, so this is should be. This is what the company has done. So I am calling it as actual. Okay, this is again should be. So what is the should be provision? Now, if you look at standard assets, then I think the provision seems to have got missed out. So that's one. This is one area where there is problem. If you look at substandard, doubtful, substandard is fine. Doubtful is again one area where the problem is observed. and loss asset seems to be absolutely in line with what is required to be done. So all in all, what do you find? Provision is not done appropriately, and there's a short provisioning. So one is appropriately, second, it is short. So it is excess or short, it is short. That is the observation. So provisioning for substandard and loss is absolutely fine. Yeah. But for the other two, this has been not done in an appropriate manner. Provisioning is short of what is required to be done. Clear? Okay. Now, let's look at the next one. Sugam Housing Finance Limited is in the business of housing finance activities. That's the nature of business. Having the asset size of 800 crores. Its principal business is of providing finances for housing mainly to individuals. Now, this is an important part, that this is mainly to individuals. It is not identified by RBI in the upper layer. Now, what do you mean by upper layer or this higher layer? Remember categorization that you do in respect of NBFCs. So that layering is what you consider on the basis of the norms. Now, under scale-based regulations introduced by RBI, what should be the appropriate classification for such a company? So that's the first requirement of the question. Number two, now the second requirement. Is there any specific reporting requirement under CARO for the audit of this type of company? Okay, so now, first of all, what do we need to check? Appropriate classification. So the said company is not classified in upper layer by RBI. Under the scale-based regulations, what do you have? NBFCs undertaking housing finance activities constitute middle layer. Okay. Asset size is not relevant in such a case. All housing finance companies not identified in upper layer would constitute middle layer due to nature of such activities which is undertaken by them. Further, so this is, I would say, first part of the question. Now, what about CARO? So let's talk about CARO as well. There is a specific reporting requirement under CARO, which requires what? Auditor to report whether the company has conducted any non-banking financial or housing finance activities without a valid certificate of registration from RBI. Okay, so this is what the auditor will have to comment upon. Okay, yeah, clear? All right, so let's move on to the third one. Abhimanyu Finance Limited. It's an NBFC. And it's in the business of accepting public deposits, giving loans since 2015. Okay, so that's the business which the company is having. So it appears to be an old company giving loans since 2015. Company had net owned funds of 1 crore 50 lakhs. So you need to be aware of the NOF criteria. So that is the criteria. If you remember, we discussed about NBFCs. So one, they need to have this certificate of registration in place. Second, they also need to have some net owned fund. Okay. Now, currently, if you look at the company, this is the net owned funds which they had and was not having registration certificate from RBI. Okay. And the company applied for the same on 30th March 2024. So if you look at the structure, so it seems they are in the business since 2015. It's been going on, and sometime during 23-24, that's what they are, I think, planning to get the registration. So what they have done is they have applied for this registration almost towards the end of the financial year. And what is that? 30th March. So that's when they have applied for this, right? Company appointed Mr. Cabra as its statutory auditor for this particular year, 23-24. Now, in this year, one more development has taken place. What is that? Company has appointed a new auditor. For this financial year, a new auditor has also been appointed. Okay. Advise the auditor with reference to the audit procedures to be taken and reporting requirements on the same in view of CARO 2020. All right. So now there are a couple of things which have been sort of, uh, which we need to consider. One, of course, the company has applied for the registration. Number two, this registration has been applied for towards the end. Okay. So considering that, is there anything that the auditor will have to consider from the CARO's perspective? So let's look at this. Now, what do you do? See, if you go by CARO, we just in fact looked at in the previous question as well. Auditor is required to report about what? Whether the company is required to be registered under this RBI Act, and if so, whether that registration has been obtained or not. Okay, so that's an important requirement. Why, you can say there is a sort of license which the company needs to have in place. Otherwise, what is it that the company is doing? They are operating without the license, actually. Yes or no? Yeah. And because this happens to be a heavily regulated sort of setup, so that's why this is not permissible. So in this case, what do you expect the auditor? Auditor is required to examine whether the company is engaged in the business which attracts requirements of the registration. Means whether the company is in the business of NBFC or not. So that's what you will want the auditor to examine. Registration is required where the financing activity is principal business of the company. RBI restricts companies from carrying on the business of NBFC without obtaining the certificate. Okay. As we have discussed, that it's a very stringent requirement. So it shouldn't happen that the company is carrying on the business of the NBFC, but the license, or you can say this certificate, is not obtained. It's a sort of non-compliance, which is not acceptable. So that is what is you'll not expect the companies to do. And this is what the auditor needs to look at. In fact, when it comes to any entity, so this is what you'll expect the auditor, that at least the license should be in place. Okay. Now, what are the audit procedures you'll have in this situation? First, auditor should examine the transactions of the company with relation to activities covered under the RBI Act and the directions related to NBFCs. So first of all, auditor should be aware of the regulations. As we have discussed, that in such type of businesses, it's not only about the financials or the entity, it's also about the regulations which are attached. So auditor will not be able to perform, in fact, think about the audit procedures if the regulations are not known. So that's why what is going to be the first step? He needs to have the understanding of the regulations which are applicable, and therefore he should be in a position to examine as to whether the company will fall within that particular regulation or within that particular criteria or not. Number two, financial statement should be examined. Why? Remember that 50-50 test we talked about? Yeah. So how do you get to know about it? From the financials. So the auditor can also pick it up from the financials. If let's suppose 50-50 test is met. So what does it mean? It's the NBFC business which the company has been sort of having. But if let's suppose that is not the case, so you'll say, okay, this test is failed. And that's how you'll assess whether it's an NBFC or not. So the financial statements need to be checked, from which this can be easily checked as to whether the company is into the NBFC or not. So we can say this 50-50 test. Next, if let's suppose the company is in the business of this NBFC, whether the company has got the required net on funds. Why? Because it's not only about obtaining the registration certificate. For obtaining the registration certificate, you need to have some capital. Okay, what is that? That is net on funds. Because it's not like any entity or any individual can get into the business. RBI has some norms. Okay, they have some thresholds. That if you want to get into this business, you need to have some minimum level of capital. Yeah, so that minimum level of capital should have been there with the company. And of course, fourth one, if at all of these things are in place, whether the company has obtained the NBFC registration. If not, reasons should be sought from the management and documented. Now, in this case, the auditor should report incorporating the following. What will the auditor report? Number one, whether the registration is required or not. If so, if required, whether it's been obtained or not. If it is not obtained, the reasons. See, the CARO is more of a checklist. So in case of CARO, the auditor will have to comment upon these points. So it's, you can say it's it's a kind of information which will have to go out in CARO reporting. In the instance case, this is an NBFC and was in the business of accepting public deposits and giving loans since it's a long period actually. Company was having net on funds of 1.5, which is less than the prescribed limit. What is that? 2 crore. Less than the prescribed limit. And the company was also not having a registration certificate from RBI. The auditor is required to report on the same in line with what CARO requires. Okay. Clear on this? Yeah. All right, so let's pick up one more. Singh Limited is a company registered under the Companies Act 2013. Company is engaged in the business of loans and advances, acquisition of shares, stocks, bonds, debentures, securities issued by government or local authorities. For the year ended 31st March 24. So again, we are looking at financial year 23-24. Following are the extracts from the financial statement. So we are given some financial information: paid up share capital, non-current assets, current assets, total assets, intangible assets, profit for the year, income from interest and dividend, gross income. Okay, this information is available from the financial statements of the company. Now, directors intend to apply for registration as NBFC. You are required to advise them on the basis of the information which is available. Now, how do you look at it? So let's try to understand that. In order to identify a particular company as NBFC, what do you consider? Both assets as well as income. Remember the 50-50 test again. So 50-50 test will have to perform. So the company will be treated as NBFC when financial assets of the company constitute more than 50% of total assets, net of intangible. And now it's and means both the criterias need to be met. Income from these financial assets, okay? Income from these financial assets is more than 50% of gross income. Okay, so in the given case, we need to consider both these tests. So if you look at the financial assets, what are those? We have 61.75 plus 312.25. So what is that? 374 crore. So financial assets are 374. And total assets, are those given to us? Yes. Intangible assets? Yes. So let's reduce the intangible assets. So it is 608. Income from financial assets. I think it's straightforward given 68 crore. And gross income. Is that given? Yes, that is also given. Now, what do we need to do? We need to do some sort of arithmetics. Quite simple. So if you look at the financial assets, they constitute more than 50% of the total assets. So our first criteria is met. So this is met. Now next, if you look at the income from financial assets, that again seems to be more than 50% clearly. Yeah. So both the criterias are met. If both the criterias are met, what do we need to do? We need to get on with the registration. Yeah. So that registration will have to be applied. So therefore, this company should apply for registration. Okay. Clear on this? All right. So now what we can do is, let me just move on to the RTP. So let's pick up some more. So this is September 25 RTP. And let's pick up some more questions. All right. So let's look at this. You are auditing the branch operations of Axis Bank. Okay. So it's a bank, scheduled commercial bank, for the year ended 31st March 25. So it's a branch. Okay. During the audit, sorry, screen is not visible. Let me just share this again. Okay now? All right. Okay. So I'll just repeat the fact pattern. So it's the audit of a branch for the year ended 31st March. And this is Axis Bank. And during the audit of this loans and advances portfolios, loans and advance, which happens to be the key area in the financial statements, what do you have? Some following, some observations are found. Advances were sanctioned without proper credit appraisal in some cases. Okay, so that's the first problem. Next, certain loans were sanctioned without adequate documentation like demand promissory notes, hypothecation letters, others where post-disbursement monitoring was weak. In several branches, securities were being held by a single officer instead of under joint custody. So that's for the better control. In fact, that's the required norm as well. A few loan accounts had exceeded the sanctioned limit and the drawing power, but no intimation was given to the head office. See, because it's a branch, so that's why when you sort of breach some of these norms, what do? You first of all report that to the parent. So the parent happens to be the head office. On pointing out the above, The branch manager replied that they rely on their internal control framework to mitigate such risks. Based on the above situation, explain the internal controls that the bank is expected to implement in the area of loans and advances. Okay, yeah. So now, considering some of these things, what is the control mechanism that you'll want to have in place in respect of this type of branch? So let's look at this. Now, what do you do in this situation? Banks are expected to implement following internal controls. Number one, banks should make advances only after satisfying as to credit worthiness of the borrowers and after obtaining sanction from proper authorities. That's in fact the first and foremost. Okay, and in fact, you get to hear about this quite a lot. All the necessary documents should be executed by the parties. Now, this is again very important because otherwise there is a risk. Because if you give the advance and the documents are not there in place, so it's a legal risk which is attached to that in terms of the recoverability. Correct? Sufficient margin should be kept against securities. So it's not like you'll go on a cut-to-cut basis. Okay, some margins. So generally, this is a practice which you follow as a bank. All the securities should be received and returned by a responsible officer. They should be kept in joint custody. Why? Because that's how you will have better control. All the securities requiring registration should be registered in the name of the bank or otherwise, accompanied by documents sufficient to give title, because that's how the bank will get secured. Yes or no? Because in future, if let's suppose there's any risk, there's default, so what will happen? The bank will lose out. All the accounts should be kept within both drawing par and sanctioned limit as per the prescribed norms. Additional temporary limit may be sanctioned for a maximum of 20% of existing limit and 90 days maximum tenure. All the accounts which exceed the sanctioned limit or drawing par or are against unapproved securities or otherwise irregular should be brought to the notice of head office. So that's in a way the management of branch, right? And this has to be a regular phenomenon. Operations in each advance account should be reviewed at least once every year. Yeah, so these are some of the controls you'll want the bank to put in place as regards the loans advances. Loans advances is a very important area. Yeah, so that's where you'll expect the banks to follow this. All right. So with this, we can just conclude our discussion. Thanks everyone for your time today, and I'm just hoping that you are getting onto the revision along with this. Thanks so much.
Thank you, Achal.
Ma'am is also here. Great.
Yeah.
Okay.
Thank you, Achal. Thanks for the wonderful session on audit of bank and NBFCs. And we have covered many questions. And dear students, thank you for attending this session. Just wanted to inform you all that we are coming out with fortnight program, right? And it's commencing from 11th of November in the afternoon at 3 p.m. So you all are requested to join the same, and also you must have received a Google form link. So you are requested to submit the same, wherein you can fill the details where you are finding difficulties, so that we can take up the same in the fortnight program. So this is one information, and our next LVRC is on Monday, that is 3rd November, right? Result of September exams are also going to be announced shortly. I hope you are working hard and preparing for January 26 examination. We are trying to reach out to you, and we are trying to handle with the help of maximum questions which you can practice. And in the class also you might have observed that we are practicing with the help of questions. Like in LVC, we used to practice the concepts. Here we are doing vice versa. With the help of questions, we are understanding the concept, right? So I hope you all are doing writing practice. In case if you find any difficulty, you can reach out to us on 0120 3045 925. Also, you can share your feedback through the feedback form, which is very important for us to improvise and look into the improvements if you want to be made by us in any of the session or in any of the topic. If you're finding any difficulty, you can let us know. We will work on the same, because your feedback is very, very crucial and important for us for our future endeavors. So it's always recommended, and it is always we always seek your feedback. So please do fill your feedback form. You can also share your doubts if any unresolved. Of course, here we are trying to cover maximum doubts if any we have received. But still, if you find any difficulty, you can use the BOS mobile app, ask your query feature, and you can write to us. There it will be resolved. With this, thank you to Achal sir. Thank you, BOS and technical support team. Thank you to each and every student. Thanks a lot. Looking forward to see you in the next session on Monday. Right. Thank you.
All right. Thank you. Thanks.
Thank you. Yeah. Yes, Manishji. Thank you.